Premiums are low in silver, but they're not below zero. I marked the zero line. We could be worried possibly that premiums are so low, but they're around what they were before silver squeeze started in 2021. But you can see here that they were below zero in 2010 and 2011, a lot of that time. So if the physical price is below the spot price in silver, the futures price, that means we're in a little bit of a silver bubble, but we're not seeing that here. Premiums remain low, but they're at 5.5%. It just means that the spot market is ahead of the physical market, and the physical market will catch up, I believe, on a financial crisis, which will happen in the repo markets. You'll see that premiums will spike just like they did over here in 2020, and I think they'll go a lot.
Red Circle breaking news for silver investors. A potential financial storm ahead. Good evening, investors. In today's economic briefing, we delve into a compelling analysis by financial expert Rafi Farber, who sheds light on the current dynamics of the silver market and the broader financial landscape. Farber's insights are crucial for anyone holding silver or interested in precious metals, as he outlines potential shifts that could impact your investments significantly. Rafi Farber discusses the current state of the repo and reverse repo markets, highlighting a potential financial crisis looming on the horizon. He introduces a new metric, the repos to reserves plus reverse repos ratio, which he uses to track overnight loans against total liquidity. This ratio is approaching levels last seen during the 2019 repo crisis, signaling a possible banking shock in the coming weeks or months. Silver market dynamics asterisk premiums in the silver market remain low at 5.5%, indicating that the spot market is ahead of the physical market. Farber predicts that a financial crisis in the repo markets could cause premiums to spike, similar to the events of 2020. Repo market concerns asterisk the ratio of repos to reserves plus reverse repos is nearing critical levels, suggesting that a repo crisis could occur soon. Farber anticipates that reverse repos will drop to zero by November, leading to a rapid decline in bank reserves and triggering a financial crisis akin to September 2019. Federal Reserve and monetary policy asterisk despite a 50 basis point rate cut.
For me, I haven't made this. I haven't configured this before, but I just configured it now. It is the repos to reserves plus reverse repos ratio. So repos to parentheses reserves plus reverse repos ratio. I want to see how much overnight loans are being made relative to the total supply of dollars available, which includes not just bank reserves, but add reverse repos to that. So here on September 18th, 2019, that was the Repocalypse, 83.13%. Usually I just show this ratio as a repos to reserves, repos to bank reserves ratio. Now I'm adding reverse repos into it to show the total liquidity. I think this is a little bit more accurate as to where we are on the timing for this next crisis. So we have here September 18th, 2019, 83.13%, and we are now at 64%. As of October 23rd, 2024. Once we hit 83%, we're going to have a repo crisis somewhere around there. Not exactly. Could be a little high, a little bit lower than that. Something around there. How much longer do we have? Hard to tell, but it's not years. It's weeks to months. We'll see how far we get in the next few weeks as reverse repos finally drop out. But here is why I think that reverse repos are finally going to go to zero by November. It's this chart. What I want to show you here is, look, we're at October 25th right now. So $202.798 billion in reverse repos left. And what you have here is you can see typically from mid-month until the end of the month, we've been having a rise in reverse repos. In September, it was pretty strong. September 16th at $239 billion to the end of the month, September 30th at $465 billion. So that was about a doubling, almost a doubling of the reverse repos in the second half of September. We had the same thing over here, starting from around August 15th, mid-month, until the end of the month. August 30th, we also saw a rise in reverse repos. We had the same thing over here from mid-June to the end of June, a big rise and then a plummet. We had 1 month where we did not have a rise in reverse repos in the second half of the month, and that was in July. So you see here we had 413 over here, and then we had still 413, so it was very stable it was 100% stable from July 15th to July 30th, 413 billion. And then we had the plummet, right, to a low of 286 billion by August 7th. So that is 413 billion to 286 billion. That's about 130 billion or something like that, 127 billion, if I'm not mistaken. I'm doing the math in my head. So now we have this situation like we had in July where we do not have a spiking reverse repos into the second half of the month. So what I'm saying is that we could be in a situation where we're about $130 billion below where we are now, which is 200 billion. That leaves about 70 billion left, because in July it dropped 127, 130 billion from where it was around the mid-month. It could be, 100 billion, 70 billion, something like that. It's going to be very low, and then we should zero out. And once we do that, bank reserves are going to start to fall very fast, and we're going to have a repo crisis, just like we had in September of 2019. And we are going to go back to the slides. In this, I wanted to show you that the rate cut, 50 basis point rate cut, has not slowed Federal Reserve losses. You would expect that they might, because if they cut rates, then treasuries will rise in value. Well, they haven't been rising in value. That's been pretty strange. I think this is the first time that a 50 basis point cut has not raised the value of long-term treasuries. They've actually fallen as long-term rates continue to rise, and since that is what the Fed holds, their losses continue. You can see their weekly losses are about between $1 and $2 billion a week, and it's been pretty consistent throughout the year. Since around February 2024, it's been that much losses per week, and it continues. The money supply is climbing at a 3.3% annual rate. I just calculated this a few hours ago. We're at 3.3%. You can see this is the highest rate of monetary inflation, meaning expansion in the money supply, since around June 2022. And you might think that this is a signal of, let's say, more inflationary stock prices, asset prices, but I don't think it will be, because if you take it into context, you can see here that the money.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Federal Reserve's losses continue, with long-term treasuries not rising in value as expected. The money supply is growing at a 3.3% annual rate, but this is not enough to inflate asset prices significantly. Precious metals outlook asterisk, a new golden cross in the gold to S&P ratio, suggests a potential bull market for gold. Farber notes that if gold outperforms stocks, investors may flock to gold and silver, boosting their prices. Additionally, a potential short squeeze in palladium could further impact the market. Rafi Farber, a respected financial analyst, provides a fresh perspective on these complex financial dynamics, offering valuable insights for investors navigating these turbulent times. As we stand on the brink of what could be a significant financial upheaval, Farber's analysis serves as a crucial guide for investors. The potential for a banking crisis, coupled with shifts in precious metals markets, underscores the need for strategic investment decisions. Stay informed and prepared as we navigate these uncertain waters. For more expert financial insights, subscribe to our channel and join the conversation by sharing your thoughts on the current economic climate. Thank you for tuning in, and stay with us for our next deep dive into the financial world.
Supply, this is the absolute, not the rate of growth. This is the absolute money supply. It's still the same as it was in October 2021. October 21, we had $21.15 trillion in the banking system. Today, or the last reading, not today, but this is the last available reading, we have $21.15 trillion, almost the same. So we have not had any expansion on net of the money supply for 3 years. So it's going to take more than a 3.3% annual growth rate to inflate asset prices from here. I don't think they have anywhere else to go but down. That is until the next printing round, but that's another story. We have the first weekly golden cross in the gold to S&P ratio since 2001, excluding the 2020 crisis over here, which brought gold to S&P up wildly because gold went down not very much and stocks crashed. So that I think is artificial because of what was done to the economy. I'm not going to count that. So the last time we had a golden cross of the blue line above the red line, we had a 10-year bull market up to the 2011 highs. And this is different now because you can see here that gold and stocks have been pretty much in pace since around 2018, but gold has not outperformed stocks since then. But if it does, and people realize that their portfolios are losing relative to gold, they're going to pile into gold and into silver, and it's going to supercharge the rally that we've already been in. We're not quite there in the silver to S&P 500 ratio, but we're getting close. You can see here 0.0052 versus 0.0058 where we are now. You can see here I zoomed in on the gold to S&P 500 ratio. You can see that they are exactly the same. 0.4411, 50-week moving average, 0.4411, 200-week moving average. And yes, this is magic. Everything in finance is magic. And no, I don't mean that literally. Premiums are low in silver, but they're not below zero. I marked the zero line. We could be worried possibly that premiums are so low. But they're around what they were before silver squeeze started in 2021. But you can see here that they were below zero in 2010 and 2011, a lot of that time. So if the physical price is below the spot price in silver, the futures price, that means we're in a little bit of a silver bubble, but we're not seeing that here. Premiums remain low, but they are at 5.5%. It just means that the spot market is ahead of the physical market, and the physical market will catch up, I believe, on a financial crisis, which will happen in the repo markets. You'll see that premiums will spike just like they did over here in 2020, and I think they'll go a lot higher than they did back then. Is there a palladium short squeeze? It looks like there might be one, because if we look here, we see the palladium price going from about $800, a little bit higher, $825, I think the low is over there in August. And you can see here that open interest has been falling as the price has been rising. This is the definition of a short squeeze. As open interest gets lower, meaning contracts are being closed out, shorts are being covered, and the price is going higher. How serious is the short squeeze? I don't know. I guess we'll see. It doesn't look so serious yet, but you can see the long-term context of where we are in open interest is still pretty elevated relative to where it was from 2020 to 2023. So there is quite a bit of way to go here for open interest to continue to fall. And if we look at the COTs, we can see that they are still very abnormal with the blues on top of the reds, meaning the commercials are long. The commercial palladium producers, the ones that make palladium, are actually long the spot price. Why would they be long the spot price? Why would they be long the futures? Because they think the price is still low, so they can stock up on physical palladium at lower prices than they would be able to produce it, and that's why they're long. And the speculators are actually short. Why are they short? Because that's what the trend has been since 2021 or so, and they're trend followers, where the speculators could be squeezed out of the market and forced to buy back. That might be what we are experiencing now in palladium, so just watch it. What do you want? Platinum? You got silver? Now would be a good time. This ratio keeps